Welcome everyone to the CVC survival game, delivering value in downturns. Today, we are excited to launch a new GCV monthly webinar series with two CVC industry luminaries who are here to talk about strategies and best practices for CVC longevity and value delivery, particularly in uncertain times. I'm your webinar host, Liz Arrington, the co-founder and managing director of the GCV Institute and a partner with the Bell Mason Group. I am also co-author of Corporate Venturing, a Survival Guide, which translates years of in-depth research on high-performing CVCs into a maturation framework and a set of design rules for building resilient and impactful programs. Tapping the wisdom of our community, the Next Wave webinar series is designed to be fast-paced and provocative, and we will be alternating between GCV Institute-led topics addressing CVC best practices and editorial-led topics addressing emerging investment sectors. These webinars will take place on the second Wednesday of every month, and they will be recorded and archived. And look for the editorial team to highlight key takeaways and expert participant insights in post-session coverage. As a reminder, the GCV Institute was established 3 years ago to unleash the collective power of corporations as both strategic investors and innovation partners. The Institute builds on and extends decades of BMG research on CVC best practices. And with our motto, by CVCs, for CVCs, we drive industry advancement with professional development and certification informed by unique operational benchmarking and enhanced by powerful communities of practice. And we are privileged to have with us today two luminary leaders of the CVC community who represent powerful examples of programs that are designed and operated to deliver value in all economic cycles. Both are GCV Institute advisors and contributing experts and mentors for our flagship Landing the Value of Corporate Venturing program. Bill Taranto, the president of Merck Global Health Innovation Fund, is a recognized leader in the digital health investing space, with his program participating in more than $6 billion in exits over the past few years, while accelerating a major Merck strategic pivot. Amy Burr is president of JetBlue Technology Ventures and is an influential travel, leisure, and sustainability investor, as well as a thought leader in the integration of investing and corporate strategic engagement across a balanced portfolio. To set a little bit of context for today's conversation, in Chapter 1 of Corporate Venturing, a Survival Guide, we talk about the post-2010 era being the fifth wave of corporate venturing, where CVCs are finally earning a place of respect and influence for the multipliers of value that they, in collaboration with their parent partners, can deliver. And increasingly, we're seeing CVC leaders have a seat at the table in corporate strategy and in setting their parents' current and future courses. I always like to say that, for example, Jaidev Shergill of Capital One Ventures talks about helping to accelerate his parents' transformation to a cloud technology company that just happens to be in the banking business, all the while delivering top decile financial returns. And on the parent side, we're seeing more and more corporations are really seeing innovation partnering as a must-have that requires a new mindset and a new skill set, and really understanding the uniquely powerful role that CVC programs potentially can play. But what really marks this next generation of corporate venturing programs is that they are designed for impact and resiliency with the explicit goal of economic cycle independence. As BMG founding partner Heidi Mason always put it, the committed corporations may turn them up and turn them down, but don't turn them off. What we see as being the three key characteristics of these fifth wave corporate venturing programs are, first of all, an end-to-end investing approach to drive both financial performance and strategic impact. Secondly, a powerful integration of corporate venturing tools, including investing, partnering, venture building, incubation, innovation, even M&A. And thirdly, the treatment of CVC as a professional sport. with a range of specialist career roles and across a range of purpose-built legal and operating structures. But corporate venturing is not for the faint of heart. Corporate venturing programs operate in a complex set of interdependent ecosystems involving multiple internal and external stakeholders. And as corporate venturing has really become a mainstream weapon in the corporate innovation arsenal, leading programs must manage hundreds of external and internal touch points at multiple levels with constant role rotations. And externally, savvy CVCs are no longer seen as poor stepchildren to VCs, but as different and potentially more impactful partners for both parents and portfolio companies, all of which can make corporate venture capital a much harder, much more complex job than institutional investing. And BMG and Institute research has shown that a distinguishing characteristic of high-performing CVC programs is an end-to-end investing approach, which is fundamental both to portfolio financial performance and to the delivery of that ultimate strategic impact that is needed to ensure CVC program longevity. And this is particularly true now in uncertain economic times. A CVC president said recently to us that, if you look at the realities of first the pandemic and now the economy, particularly for programs that have off-balance sheet investment funding, strategic engagement is the survival piece. My parent could turn off my dollars and I would still have value to deliver. So over the past 7 years, we've seen high-performing CVC programs increasingly and seamlessly blend top VC investing talent and corporate venture business development or portfolio development professionals who are tasked with driving ecosystem engagement. And externally, these professional CVBD or portfolio development platforms are really seen as a powerful source of competitive advantage for top CVCs, particularly in complex and regulated industries. Programs such as Munich Re Ventures, Chevron Technology Ventures, JetBlue Technology Ventures, Intel Capital, and Echo Health Ventures are really leaders in the establishment of these powerful engagement platforms. So, let's hear from two of these leaders, Bill Taranto and Amy Burr. And Bill and Amy, to start the conversation, can I ask each of you to spend a couple of minutes introducing yourselves and your programs, including, when was your program established? What is your charter? How are you structured? What's the scale of your operation? And a key measure of resiliency, how many executive transitions have you survived? So Amy, do you want to go first?
Sure. Thanks for having me. This is a great topic and one I love to talk about. Amy Burr, president of JetBlue Tech Ventures. I have been with the company since 2018, and I actually started as what we call operations, but is our business development team, our innovation team. So I came from that side of the business. My background is aviation. I've been in the airline industry for 20 plus years, but was a founder at Virgin America, so I understand the startup world quite well. So that's me. Our team and our organization was created back in 2016. And it really was created because the board at JetBlue, kind of looked around and said, JetBlue is not the innovative airline that it used to be. It's hard when you continue to have operational challenges or you're just focused on the operation to remain innovative. And how are we going to stay ahead of the game? And at the time, they decided that the best way to do that was a corporate venture capital firm. And so we are a wholly owned subsidiary of JetBlue. We are 12 people. We have an operations team and an investment team. I think we'll talk a lot about that later. Our charter is to invest in early stage startups in travel tech. And when we say travel tech, across all of travel. So it could be, aviation specific, it could be mobility, it could be hospitality. We are very focused on sustainability in travel, very focused on, kind of next gen operations of travel companies. So we really do have a pretty wide charter across travel, across the travel ecosystem. Let's see, what else do we have? We have invested in 40 companies to date. So we are just over about just 6.5 years old. 40 companies have joined our portfolio. We've done more than 24 as of right now, another one coming down the pipe, follow-on investments. We don't talk about our fund size. It's just something we don't publish publicly, but you can kind of gather about what our level is based on the fact that we have 40 portfolio companies, minus a few exits, which are great, and minus a few unfortunate companies that have gone under. Let's see, what else do I have? We have not survived a chief executive transition. We still have the same chief executive as when we started, but we have survived an entire board transition, including the chairman. Our board has really turned over kind of in the last 6 years, quite a bit. About maybe 2 or 3 years ago, we really started kind of, some of the older board members had decided to leave, and new board members were established, and a new chair was established. And we are still have as much support, and there's definitely a love for JTV within our board, and so that has been very positive. I'm sure at some point we will we will go through a CEO change, but hopefully not anytime soon, because we love Robin, who is a big fan of ours.
But your executive sponsor has changed, haven't they?
Our executive sponsor has changed. Our executive sponsor originally was our chief information/technology officer, who actually left the organization, and we actually shifted where our kind of executive sponsor is actually our general counsel. And the way we think about that at JetBlue is that he has several different organizations that are structured around risk mitigation. And that's the way we think about the work we do. We're looking ahead at our industry, at, kind of our adjacent ecosystem industry, and saying, looking to see what is a risk for our organization, what are things we can take advantage of, how can we, use emerging tech in a way that is positive for JetBlue in the long term. And so we kind of think of his portfolio as a little bit of risk mitigation. He has cybersecurity, he has ESG, which is obviously a huge risk to mitigate, especially in the travel industry. So we have changed executive sponsors, which has been great. He's actually been the chair of our investment committee for many, many years anyway. So it's been a positive transition.
Excellent.
Anything I forgot that you'd like me to cover? Obviously, we'll talk a lot throughout this webinar.
This is a great start. Bill, tell us a little bit about Merck Global Health Innovation Fund.
Thank you. Well, good morning, good afternoon, good evening to everybody, wherever you're calling in from. My name is Bill Toronto, and I'm the president of the Merck Global Health Innovation Fund. And for those who heard me talk before, I was at Johnson & Johnson for 18 years prior to joining Merck, and I established the fund in April of 2013 when Merck basically had recruited me from Johnson & Johnson. And Merck hadn't really done any type of venture capital before, but they really wanted to start exploring, at that time, external innovation using venture capital as one of their tools. And for the most part, that's pretty much what we're doing today, with the remit slightly changing, but not too much over time. So again, we've been active for 13 years at Merck. We're a 13-member team, which including myself, we have 5 investors, 3 analysts, and 3 admins. It's been a small team for the most part, and mostly everybody's been with me the entire time except for the 3 new analysts that we've hired. So it's been a pretty steady team that's been together for quite a long time. As it relates to our charter and structure, we're a separate LLC. So we're an independent P&L that reports up to Merck's master P&L. And we're interesting about Merck, they're really a single P&L. We're one of the only separate P&Ls that operate within Merck, which gives us a lot of independence, which we like. And I know we'll talk about that a little later. What we do for Merck is we're a digital health fund. I'm not a therapeutic fund. We're probably one of the largest, if not the largest, digital health fund in the world. To date, we've done over 70 investments. Our current portfolio today is about 34 investments. So we've exited over 40 companies. We're probably one of the most successful funds in the world. We've actually only had 4 companies that we've had to completely shut down. So if you look at the total number of exits we had, they've all been quite profitable and done quite well for Merck. We're a growth investor, so we're mostly Series C or later. We're a $500 million evergreen fund, so we typically come in when that company is looking for that growth capital. We do an A and B round occasionally, but we're not chartered to do any startup or seed capital, so we don't work in that early part of the investment world. But again, mostly Series C or later, and we typically like to write checks in the $10 to $15 million range with follow-on in the same amount. We do a lot for Merck across all three divisions. We invest on behalf of our Merck Research Labs, which is our R&D organization, our Human Health organization, which is our sales and marketing organization, and our Merck Manufacturing organization. So we cover all parts of Merck, and we're responsible for trying to find, differentiated value in healthcare beyond the pill, if you will, or beyond the therapeutic that can either enhance healthcare, generally speaking, or enhance the way Merck or other pharmaceutical companies go to market. And that's really generally our remit. As it relates to executive transitions, I saw that Liz had sent a note that anything more than 2 is resilient. Well, I can tell you I'm on my 3rd CEO, and I'm actually on my 10th boss. And we've reported up through mostly the chief strategy officer or the chief financial officer, but we did one small stint for 2 years under the CIO. And I'm currently today reporting up to the chief strategy officer. That's up through the executive committee. So we had quite a bit of change, from a standpoint of leadership. And we're overall governed by a board because we're an independent LLC. Even though I do report to a certain person within Merck, we're actually governed by a board that oversights what the fund does, from allowing us to do investments, how much we can invest overall, and usually what the overall charter is should we have to change, which we did a fundamental shift in 2016 when Merck went from a primary care company to an oncology-based biopharm company, which was a massive shift in not only what we were doing, but in Merck's overall strategy. And I know Liz will talk quite a bit about how you remain resilient within those kind of changes. But that's the overall sort of 60,000 foot view of the Global Health Innovation Fund.
Great. Well, thank you for those introductions in that context. I'm going to jump in and ask you guys a few questions, but I'd like to encourage the audience. If you'd like to ask your own questions, please use the Q&A function, and we'll try to wind those in as we go. So first question I have for both of you is following 2 years of pandemic boom, we're now facing economic uncertainty and even talk of recession. But despite the slowing of VC investing, global corporate venturing is not seeing CVCs running for the hills en masse like they used to. And even those that are dealing with corporate performance and corporate restructuring issues, it seemed to be talking more about streamlining than about actual program elimination. And we are still seeing new program announcements, although they're happening at perhaps a slower pace. So I wanted to ask both of you, what are your views on downturns? Are they threats or are they opportunities for CVCs and for your program in particular? And let's start with Bill, because I think you've gone through downturns in the past with J&J, and you're potentially facing another one with Merck. How do you see downturns?
Yeah, I think the misnomer a little bit is that because we're in an economic downturn, there's actually something wrong with the portfolio company. And that's not usually the case. It usually means the company is probably strapped for cash. There's other economic reasons that affect the company, but we actually view it, and especially as a growth investor, as an opportunity. We don't actually see this as a downturn. I have this phrase that we use. It's called the dented can approach. And what you can see is in a downturn, we knew in the last 2 years in healthcare, there were a lot of high valuations within digital health. And a lot of those companies can't support those valuations today, but they need to raise capital. There's nothing wrong with the company. They're just struggling to raise capital at the value in which they were. So we see that actually as an opportunity for a lot of different ways to recap companies that we maybe originally wanted to get in that couldn't get in. Companies that are complementary to our other portfolio companies, or as you know, we run a private equity function. We call them roll-ups. Could we actually take some of these companies and merge them with our current portfolio and create a larger company that creates scale, which is one of the hardest things to do in healthcare, is to create that scale. So I think it a little bit depends on a little bit what your stage investor you are, but I still see that the downturn doesn't always have to be negative. I still think there's a lot of tremendous opportunity. But the reality is these companies are going to struggle for cash. That's the biggest issue that you see within the downturn. Can they survive with enough cash to move forward? And one of the odd things that we've seen during this time, especially in healthcare, is I probably did more follow-on investments in the form of notes this year than I did equity. And the part of it was just to try to keep a flat round going. But we need to keep these companies moving forward. I think that's the other great opportunity, is that the reason you invested in the first place doesn't change. Yes, we're in an economic downturn, but you still should provide capital for the company to do the things that you wanted it to do in the beginning, which is hopefully as a corporate, begin to deliver strategic value to your corporate and then into the industry that you're in, and certainly for us more broadly to the healthcare market. So I always have looked at it as opportunity. I actually never saw the downturn, but it takes a tremendous amount of patience. And you got to play for the long term in these downturns, because sometimes they go quick and other times, like this one, is probably going to take a little longer. I don't think and remember, we lag behind, the public market. So we're probably a year behind. So this is going to go into next year, and certainly within healthcare, it's going to go in it. But I've always found this is a tremendous opportunity for either M&A roll-ups. And I believe that you shouldn't walk away from these companies. They're still good companies that are being affected by something that's out of their control. And I still think they can deliver the value, but you got to play the long game and stick with them.
Yeah. I mean, your model's a little bit different. I think you invest a little bit earlier, and you do have kind of a balanced portfolio strategy. So how do you see downturns, and what is it, a threat or an opportunity for your program?
I think of it as definitely an opportunity. There's obviously, challenges that come during this period of time. Let's use the pandemic as an initial example. I kind of feel like if you made it through the first 4 months of the pandemic intact as an organization, you're not going anywhere anytime soon. And that was true for JetBlue Ventures. We really, had a moment of like, okay, is this it? Is JetBlue going to stick with the CVC, or is this going to be the end? I mean, if I would say out of all industries, the pandemic hit the travel industry almost more than most, right? We definitely had a complete stoppage of flights, and it was just a really challenging time. But that is where you do get to provide your value, and you show the mother, your mothership, so to speak, all of the value you bring from the innovation side of the business. Innovation. It's so important, and crisis breeds innovation, right? If you're in a crisis and you take advantage of that opportunity to think about new and interesting ways to do business, then you are an organization that's going to live for the long term. And so, the encouragement, obviously, for corporations is, use your CVCs during these periods of time to actually double down on innovation and double down on investment in different opportunities. Now, that being said, obviously, we took a pause during, kind of the first initial part of the pandemic and didn't invest as much. We do invest in early stage startups, so that can be a little challenging, especially in travel during that period of time. So we took a little bit of a pause, and we really doubled down on the innovation side of the business. And coming through the end of the pandemic, we're in a weird position compared to a lot of CVCs. Travel is through the roof, right? Everybody wants to travel right now. It's actually a really good time for a travel company. I mean, it's a good time for travel startups. But we recognize that may not always be the case. And as we go into 2023, it may be a little bit more challenging. But still, our organization has, recognized the value of having our unit there for innovation purposes and investment purposes. And a lot of the work that we do is thinking about 5 to 7 years out in our industry. So if we stop investing in that now, that means in 5 to 7 years, we're not ahead of the game. And so the good thing is our organization really recognizes that. So I would say, times like this are definitely opportunities. If you're a CVC and you're worried about, this kind of an economic downturn and what's going to be the next step for you, now is the opportunity to really double down and show your value from an innovation perspective and from a biz dev perspective, and really, show the value that you can bring to the organization and helping them think about things differently. Because that's really ultimately what we're here for, to help the organization think about their business differently. And so that's what we're really focused on. And yes, we're keeping an eye on things. I agree with Bill. Like, some of the real benefits are things like valuations coming down. I mean, there were definitely some, late 2021, we were like, the valuation on these companies, especially for early stage companies that we're trying to invest in, they don't make sense, right? And we're struggling with that. And we passed on a couple of deals that we really loved, but we just couldn't, we couldn't justify the valuation. So I think valuations coming back into line is going to be important. And I think that's great. And that's what we're seeing. I think, Liz, I think maybe you guys put out a statistic, or maybe the greater GCV organization put out a statistic about Q2 investment, about how investment deals were down like whatever 8%, but the valuation of those deals were down like 40%, and that's what we're seeing, right? The valuations are coming down. We're doing a ton of notes too. We definitely have a lot of follow-ons that are being brought forward from our portfolio companies, because it's important to support these companies during this period of time, and they're all, the biggest focus they have right now is conserving cash and making sure that their balance sheet looks good going into a potential maybe deeper downturn in 2023. We don't know what's going to happen, but we want to be prepared for that. So anyway, long story short, I think that this is an opportunity both for CVCs as well as startups. It's just about how you kind of focus your efforts during this period of time.
Right. Well, and both of your programs do take what we call an end-to-end investing approach and integrate the professional business development or alliances capability with your investment team. And CVCs often get the question from their parents, why not just partner? Why is it important to invest as well as partner with startups for both the portfolio company and the parent? How do you address that? Why do you need to invest as well as partner?
Well, I'll throw out a tidbit and then pass it over to Belle. But one of the things, how we look at this, one of the things that we really focus on is, first of all, we don't bring startups to JetBlue and say, here's a new business partner for you. We bring startups to JetBlue and say, here's something for you to try. And we really focus on trials. We really focus on proof of concepts. We really focus on proving the business case and showing the value of these startups in our organization, in our industry. So, we really want to make sure that they recognize that this is about, we invest in the ones we think are the right ones for the future. And then we also try a ton that we don't invest in, right? And so I think both sides are really important. And we want to make sure that we kind of, focus on that throughout the organization. And that also helps the organization kind of figure out how to ingest these startups. They're like, it's a startup. What do we do with this? Like, they don't even understand, they don't understand like how to work with us. And like, they don't have to understand how to work with you. We have to understand whether they're valuable, and then we can figure the rest out. And so that's a lot of the work we do. My team, my operations team, which is our innovation biz dev team, spends so much time hands-on working with the business organization and the startups to say, hey, is this a possibility for you? Will this prove to be valuable? How can we prove that? So that's a lot of the work that we do, for sure.
And Bill, how would you answer that question? Why is it important to invest?
Yeah, I think we take a slightly different approach. So we do three types of, we call it investing. So we do something called invest and partner, and then we do invest, and then we do something called next horizon. And in the first two buckets, there's a real reason why we invest in both those buckets. So in an investment partner, that's where we're committing a pretty sizable amount of capital, but Merck's also committing a pretty sizable amount of capital to the commercial agreement. And then in the second bucket, where we're only investing, it's in lieu of Merck coming forward in about a year, maybe it might take 18 months, where the company needs to get to a certain point in maturation in order to deliver what Merck actually would want it to deliver, or any other pharmaceutical company. But why it's important to us to invest is a number of different reasons. We can exert a lot of influence because we're very active investors and we take board seats. And one of the things we want to make sure is that the use of proceeds and how the company is moving forward and how they're doing their development program actually can deliver for what not only Merck, but what pharma is looking for. We're a very complicated industry to work for. And so it takes a lot of hand-holding for these portfolio companies to understand how to deliver for life science companies. It's not very easy. So we have found that the reason we do both is we want to, and it gets to what Amy was saying, the company learns. So that's sort of the partner piece. Merck, you also have to learn how to work with these types of technologies that you've never worked with before. But we also need to invest in order to influence it so the company can actually deliver what you need to do to learn and work with them. It's sort of a symbiotic sort of way. So we look at it both ways. We sort of do a combo of both, in which we're trying to do both where we're really sure up front that Merck wants to, partner right away and we want to invest right away. But we also want to develop a company to give Merck a little more time, the company a little more time to get to know each other. And that might take a year or 18 months. And of course, in our next horizon bucket, that's something that we're looking 5 years out. And maybe Merck might, at a take a little pilot just for fun, something in quantum computing, which we don't even know what the impact on healthcare is. But it might present an opportunity, but we're not looking to necessarily do partner there. That's really investing for us to learn as an investor, not so much for Merck to learn. We're trying to understand whether or not that will have an impact on healthcare in the next 5 years. So we try to look at it 3 different ways, but we think it's important that Merck, no matter what, at some point participates with our portfolio companies. And out of our 34 portfolio companies, they're currently contracted with about 80% of our companies.
Wow. Yeah. So it sounds
if I may, Bill, that was really well said. And I think we're very similar in that perspective. Like, we do invest to have a seat at the table to help these companies develop. I think that's a really great way of putting it. And one thing I did not say, which is, I think we have very similar programs from that perspective. Although we do not have a requirement that an investment that we make, we have 3 time horizons. One's real near term, and it is something that JetBlue should be trying right away. One that's kind of 2 to 5 years out, and one that's 7 to 10. And the 2 to 5 and 7 to 10, there is no requirement for there to be an initial engagement with JetBlue. So it is about us learning and have a seat at the table and helping these companies develop. So I just wanted to say, great way to put it, and very similar to how we are structured.
Well, can I get each of you to spend a couple of minutes describing what your respective models or platforms are for parent engagement and portfolio support? So what are the key capabilities that are needed on your team to really drive your charter, particularly now? So Amy, you want to start with that one?
Sure. Okay, so we have a couple things going on to kind of address exactly this point. As I alluded to in the beginning, we have, half of our team are investment professionals and half of our team are operations professionals. And by operations, we mean industry, experts, people within the organization that are focused on innovation, on business development, on marketing and communications, all of those types of things. So the way we structure this, I'm going to address this in 2 different ways. First is kind of parent engagement, and then second is portfolio engagement. Similar, but slightly different initiatives. So we spent a lot of time with JetBlue and JetBlue Travel Products, which is another wholly owned subsidiary of JetBlue. And we spend that time doing a ton of innovation work. We do innovation sprints, which is a specific program over a 12-week period to deep dive into a specific area that brings a lot of startups kind of in front of a business unit. We do, just kind of strategic reviews of the marketplace and what might be out there, and what emerging tech is happening, and what kind of the next generation of technology we can take advantage of is. We do a lot of proof of concept management. We actually will program manage a proof of concept for somebody so that they don't feel that it is a burden for them, that they can try these things out without it being something that takes away from their day-to-day. So we do all of these types of programs with our innovation team, with JetBlue and JetBlue Travel Products, and we're super embedded with the business units from that perspective. We have 2 people who actually sit at headquarters and spend all their time talking to the different business units, and then we just have so much work we do with them. During the pandemic, that was super critical because that team was very, very busy, right? Trying to find interesting ways to deal with the crisis at hand. And then we have our investment team, which are very skilled investment professionals, and they're there to look for the right deals, to make the right deals, to help our portfolio of companies grow, to do all of those things. So we spend so much time with JetBlue. We spend a lot of time with our portfolio companies. So we have a formal platform for portfolio success that is actually run by our comms and marketing function. And it has the business pillars of financial support from our investment team, biz dev support from our operations team, comms and marketing support from our comms and marketing team. So we actually help our portfolio companies in that way, in a very structured kind of program that we developed over the 6 years. The biz dev side, the operations side, the innovation side, that's been there from the very beginning, and that's about bringing value to JetBlue. So that's how we tackle these kind of different things, and we think super valuable for both our portfolio companies. They're very, we're very hands-on with our portfolio companies. We help them with everything, biz dev, figuring out their entire world, recruiting, legal, whatever it might be. And then we do spend an incredible amount of time with JetBlue on the innovation side.
Right. So that's how you use that embedded team to really get a sense of what the priorities are within the operating businesses and the real hot buttons.
or even, there's the push and the pull. What are they looking for? But what do we see that they don't know is out there that could really change a pain point that we know is there, because a lot of our operations team are industry professionals, as I was. So we know what the pain points are. We know what the challenges are in travel in general. It's a very highly regulated industry. We understand that aspect. So we may see something and bring it forward as well.
Right. And I think, Bill, you have firsthand experience in sort of helping the business to see what they're not aware of, or being kind of ahead of the business. So how do you use your strategic innovation alliances team in conjunction with your investment team to drive the GHI charter?
That's a great question. And we're very similar to JetBlue on this as well. So we created about 4 years ago, maybe 4.5 years ago, something that we call enterprise coverage, but it's really just a strategic alliance group. It's a kind of a fancy name we came up with. And the group has a number of different roles, of which both the investor group plays a part in, and then we hired some people to actually manage what we would call the actual alliance piece of it. But the first step in what they do is much what JetBlue does. Is we actually go out to the organization. So each investor on my team is assigned a part of the organization, and they sit on the leadership teams of all these organizations. And what their role is to go out and listen. What are you seeing? What are you? We call them use cases in healthcare. And all use cases is a problem Merck's trying to solve, or the department's trying to solve, or the part of the business, what are they trying to solve? But we call them use cases. And it's, what are your use cases, Merck? What are you trying to solve? And then much like JetBlue, we're also there to say, but you're missing this piece. This is what we're seeing that's happening within healthcare that might help you solve that particular use case, or a use case that you haven't seen yet, because this is happening in healthcare that you're not aware of because you're focused, on your day-to-day business. So that's sort of the first step. Once we then identify what the use case is, what we then do is put our sort of alliance management function together, because one of the things we learned was, how do we get accountability for not only the portfolio company to do what they're supposed to, but even Merck to do what they're supposed to do? They don't just sign an agreement and go, okay, good luck, portfolio company. There actually has to be work done by both sides. And we're that middle person to manage, both parties in a sense. But we also help work on, what is the scope of the project? What are the things you're trying to accomplish? What are going to be the deliverables? We don't negotiate the agreement. We're prohibited by law because this is the way pharma is structured. We're not allowed as GHI. We're responsible for the investment, but we can play the middleman and work with our BD&L group to actually negotiate the agreement. We're not responsible for that, but we can work with the scope with both parties. We can make sure, the portfolio company deliver what Merck's asked for, but Merck's not doing scope creep, asking for more than what the portfolio company can deliver. We set timetables. We set, key deliverable dates. We set milestones, and then then the actual deliverables. And then we actually set up the communication of what happened after. One of the big things that we do after is we report back the good, bad, or the indifferent. What happened? Was it successful? Was it not successful? Was it mildly successful? What worked? What didn't work? How can we do the engagement better if there's a follow-on engagement? So that's all done by this group. But I would just call them almost the middle man or middle person within, between the portfolio company and Merck. And it's worked out really well. Like I said, once we started this group, we had a massive increase in the number of commercial agreements that were signed between our portfolio companies. In fact, in the last 2 years, we've had over 30 agreements signed. And that's just simply because of the maturation of our team, us better understanding Merck, and then having a proper procedure and policy system in place of how this all works together, and how we actually move something forward from just a use case to an actual agreement. So I think it's worked out really well for us in the last few years. And now the problem we're running into is we're too small of a staff to support it. It's gotten too big. So we're trying to figure out, how do we bring in additional personnel to manage, because all we're going to see is these use case and commercial agreements increase over time. And we're barely managing the 30 some odd that we have now.
Right. Yeah, we have a question from someone in the audience that says, with 5,000 priorities within the operational businesses, what have you found is fundamental to getting in, to maintaining traction, and I would guess to prioritizing what you work on? Yeah,
that's the main thing. First off, we do have a remit that we can't do. Merck's a in 140 countries. It's a massive organization, and we can't solve every use case, nor do we have the funds to do that. And so what we try to look at is enterprise-wide solutions. You know, what is a use case that our human health is working on, that our Merck research, but they call it something different, but they're actually the same use case, that if we actually invest in a portfolio company that solve both of them, even though it's the same thing. So we're operating more on an enterprise. So we're looking for the use cases that have the broadest impact on Merck, and then what are the best portfolio companies that can have the broadest impact across Merck. One of the things we avoid are one-offs, because I can't invest in a company just to serve one teeny part of the organization. It doesn't work. So one of the mandates that we have is that when we do these partner invest programs, they're thought of as an enterprise. Not cover the entire enterprise, but it could actually cover, you know, an entire organization like Merck Research Labs. And it cuts across all the different parts of Merck Research Labs. So we think more in terms of enterprise, and then of course we go through a priority process. You know, for example, we stopped engaging in almost 40 potential commercial agreements that we said, no, we don't think those are worthy because they're not big enough. They're too many one-offs. And so you have to have a lot of discipline and you have to say no, because there's just not enough resourcing. But it is a prioritization process that you have to go through.
What about within JetBlue? How do you handle this?
We look at just a titch differently, only in that for us, the bigger prioritization is what do we invest in versus what do we not invest in? Because again, we're not focused on pushing commercial agreements within the organization. What we're, you know, let me tackle this in two different ways. For the organization and just solving problems for JetBlue, we are constantly bringing things forward that are generally around the edges. Like, we're not, you know, a startup's not going to fundamentally like replace the reservation system of an airline. It's a big, you know, complex program that, you know, if a startup actually gets to that point, that'll be amazing, but I don't see it happening yet. Like, so we're like, okay, well, what can we bring forward that is a customer, you know, facing tool that attaches to the reservation system that exists today? You know, like, because we're a little bit around the edges on some of those things. So we spend a lot of time, you know, kind of prioritizing what the organization is looking at for the next 2 years. Like right now, there's a big push for operational efficiency and operational like cost efficiency, as well as, you know, actual like work efficiency. So, you know, we're thinking about, you know, next gen aviation operations and how AI or you know, AI and machine learning, or even quantum computing. We actually have a couple companies that are, you know, in the pipeline that are thinking about how that will change operational efficiency. So that is a priority, right, for JetBlue. And so we prioritize what we're looking at based on what they're looking at. For the last 2 years, one of the biggest priorities has been sustainability, and that's not going to change. So we've spent a lot of time on sustainability companies, you know, future looking, kind of what is going to move the needle on on decarbonizing our industry. So those are some of the things that we're prioritizing. But we bring forward a lot of startups that we will never invest in. You know, they're just, again, you know, kind of similar as Bill mentioned, like they're just too niche. They don't cover a big enough problem. They're a tiny little, you know, kind of bit of the organization that we're not going to invest in that. Or we're probably not going to invest in that, because that's not, you know, we're still investment professionals. We're still thinking about what is a good investment. And those aren't great investments. That may be a great one to bring forward for a partnership, but it's not a great investment. So we prioritize our you know, kind of partnerships that we bring forward based on anything that the organization's looking at. We prioritize our investments based on the things that are you know, bigger and longer term, and, you know, are focused, you know, within the kind of next 2-ish, 5-ish years of strategy for JetBlue. So, you know, I think similar, but like, you know, we focus on it, you know, we prioritize for ourselves more the investment side, and we bring forward all of the things that JetBlue might want to try within the business.
Right. And one of the barriers that we see to engagement in many cases is who's going to pay, particularly for the early proof of concepts or pilots. So do your programs have slush funds or have mechanisms for enabling the business to?
We definitely do. We have a proof of concept fund that is a JetBlue Tech Ventures, you know, P&L line item. We are an LLC as well, so we do have our own kind of balance sheet and structure. The key is it's got to be beneficial for JTV as well. So if we're investing in a proof of concept, there has to be some reason why it's going to be beneficial for us as well as JetBlue. Just based on what we think are the right focus on accounting roles. We don't want to. We're not trying to shift cost out of the main P&L of JetBlue into JTV. We're trying to benefit both organizations. So we'll do a proof of concept with an organization with a warrant structure attached. Like, if we're paying for the proof of concept, we get some small amount of equity because of that. Or as we do an investment, we'll also pay for a proof of concept. So there's got to be some kind of benefit for us as well.
Well, what about Merck? What does GHI do in that regard?
Yeah, so we do it slightly different. So it's typically after we've already done an investment, and what happens is sometimes our investments come in mid-cycle around budget, cycles for within Merck, and we have something called a PAP program, which is a portfolio advancement program. And it's a $5 million corporate. It comes off what we call the CEO's annual budget, and it's a $5 million program in which we can put up to anywhere from $500,000 maybe to $700,000 to start a pilot for the portfolio company with a department. And again, trying to solve a use case. But the way the agreement works is that we'll start it, but they didn't have to commit to the budget once that maybe the $700,000 lasts for 7 months. After that 7-month period, they have to commit the money, but we sign an agreement with the organization up front that they're committing assuming it's a successful pilot. If it's not, there's obviously no reason to continue. But assuming success, they actually have to pick up the budget. So it allows us to, at least off budget cycle, get a pilot going and get Merck working with a portfolio company when they don't necessarily have the budget, at this exact moment. And so we do that, as often as we can, off that annual budget. So it's helped tremendously because it's gotten a lot of sort of proof of concepts done with existing investment companies that Merck wouldn't have been able to do till like another year from now or another 18 months from now because it was just, didn't fit the budget cycle. So it was a way to combat Merck's sort of odd budget cycle that the way they're structured.
Right.
So, but it's worked well.
Right. Great. Looking at both of your cases, you've taken a slightly different approach, but I'd be curious as to what your view is as to what is the right time in the evolution of a corporate venturing program to establish this business development or portfolio development capability, and how do you use it to engage the parent at multiple levels? So I think JetBlue started from day one with this capability.
Yes.
Right?
We did. And of course, that's going to be my answer of like, when's the right time? Day one. But I recognize it's not that easy, right? It's not that straightforward. And honestly, our biz dev kind of function, our operations function in the early days was very small. And, part of, the goal of a CVC and part of your challenge as a new CVC is building credibility within your organization. The more that you bring forward that is compelling and interesting, the more successful companies that you bring into the organization that are used either, have a successful pilot or become a business partner, the more credibility you have. So over time, in the early days, it was a lot of us being like, let us help, please, let's do an innovation sprint. There were a couple, leaders within the organization that were really excited about that because they, kind of are more, in tune with the startup world. And there were a lot that were like, I don't know about that. But over time, what we've seen is this shift of like more people coming to us saying, we need your help. That we are not equipped to figure out what's the next generation of technology in our space, and you are. And we've established ourselves as that leadership within the JetBlue team that we are the people to figure out what's the next generation of technology that can help our company. And so as our credibility has grown, our requests have grown, our operations team has grown, and that's the kind of natural progression. So I do think it's important to start from day one and establish that function, but know that it's going to be something that grows over time because you do have to build that credibility. You do. It's important for you to do that. And that's how you also survive as a CVC. The more you build that, the more likely you are to survive.
And you really stitch yourself into the organization at multiple levels.
Exactly. I mean, we do. We spend time with all levels of the organization, from the working teams of analysts and managers and whatever to the executive team. And that's an important piece as well.
Yeah. So Bill, I think you've taken a slightly different approach where I think the starting especially as an adjacency fund, but how would you answer that question now, looking back? What do you think is the right timing?
I would agree with Amy. I would have started it on day one. I think it was a learning lesson for us, 100%, or within the first year, because as Amy said, it takes a little time to get your fund going, but certainly by the second year, you're going to have enough investments that you need this organization. And what I learned is where it would have been more impactful in the early days of the fund is exactly what Amy was talking about, is communication. Today we communicate all levels of the organization, where at the very beginning of the fund, we were only communicating above us. And it was mostly the executive committee or the highest levels of the organization. And the problem is that's all good and fine, but the work gets done by the next level and the next level beyond, lower than that. And you have to engage with them as well. And this would have allowed us to really enhance our communication, helping people understand what we're here to do, how we can help, how we can be a resource to them. And so I 100% agree. That's, whether you want to call it a mistake or not, we should have started this function way earlier. It's so important to the success of a CVC, helping you gain credibility, really helping you understand your organization and all their needs, but also delivering the value that you have as an expert on external innovation. And so, yeah, that's the one thing I would have done 100% differently, is started this way sooner. It's been a valuable lesson. We obviously, still survived nonetheless, but it would have been just a wonderful resource to have much earlier in my career at work.
Yeah, thank you. Well, looking at the value delivery question, I one final question. Everyone always asks about, what are the specific metrics that you use to measure and show the value of your CVC investments, particularly during crisis times? And I look at it as what is it that makes a CVC program a must-have versus a nice-to-have in the minds of the corporation? So I'd like each of you to spend a minute talking about, what do you measure and what do you talk about to justify your existence and make you a must-have. So Bill,
I'll go. I certainly think that we're measured in two big ways, which is financial returns, because I'm an evergreen fund, so I must be self-sufficient. And then the second piece is obviously strategic value. Are these investments that we're making helping Merck be better at what Merck does? It doesn't mean Merck has to acquire any of these companies, but is Merck learning? And it's important for these assets to exist in the world, so not only Merck but other pharmaceutical companies can engage and learn. And then the secret sauce is just what the company does. So that's why we don't necessarily have to own all these companies, but they need to exist. But we have to show that yes, they're existing, but Merck, you're learning and growing and changing the way you're doing business that makes you better at what you do, which is ultimately, delivering ethical pharmaceuticals to the market. And so that's how we're sort of measured. And that's where that alliance piece comes in, because that's where we measure that sort of strategic component of it. And of course, the financial gains are the financial gains. But one of the nice to haves, though, I was thinking about this question a little bit, is I think one of the things that helped us tremendously is, I don't tin cup it within Merck at all. We had all the money up front, which was, an interesting way to start a fund, was, not having to do capital calls, and it gave us a little sense of freedom, to invest, because we weren't worried about whether we had to get money from other parts of the organization. Somebody had to co-invest with us within the organization, or we actually were an independent fund that had their money and could go out and do the job that they hired us to do. So I always kind of look at it, you don't need to have it, but it's certainly nice to have if you're not working off an annual either allocated budget or capital call. I think having the ability to work in an evergreen function, and you have all that money up front, and you can prove your worth, that you can be self-sustaining, I think is an important component that's a little lost sometimes on when these funds start. But I do understand that it's a risk for companies why they may not want to commit all that capital up front. But I think it makes a tremendous difference in what I call freedom to operate.
Mm-hmm. So Amy, what makes you a must-have? What metrics do you use to talk about?
Okay, well, it's actually really we're a nice compliment here, because I am not an evergreen fund, and I do have capital calls every year. And so the way we're structured is every year, I have a conversation with our CFO along with our investment committee, and we talk about what we need for the following year in terms of investment money, and then we get a bucket that we freely invest off of for that year. But every year, that's a same conversation, right? So it would be wonderful to have an evergreen fund. So if you're creating a CVC, anybody who's in the audience, evergreen funds sound really great. I would go that route. But no, I mean, it works for us, and it is important for JetBlue to structure it this way, and that's great. So how do we actually provide that, or how do we prove our value every year? So a couple different things. We are measured from a financial perspective. How is our portfolio doing? We're just at that point. We're 6.5 years. We're just at that point where we're starting to really see our exit numbers ramp up. And that's huge, because now there's this theory of like, we're kind of self-funding, in a lot of ways, right? We're bringing back money into the organization that, creates this funding mechanism for the future. And that's wonderful. But, we've always been measured on our financial performance. How are the investments that we're doing, how are they, valued over time? A lot of that, of course, isn't real until it exits, but we all do measure TVPI and IRR and all of those types of things, and we talk about that a lot. We tried in the early days to think about how we could measure like revenue uptake or cost savings, or even some sort of a nebulous efficiency gain, and those things are really, really hard to measure. And so my advice to every CVC, and I've had this conversation with a number of CVCs, especially new ones, it's hard to really attribute a specific revenue amount or cost savings amount to a specific little company that you've brought into the organization. There's so many factors involved with that. And so, is it really because of this startup, or is it because you changed this process, or because of this external circumstance? It's really hard to measure that. So we don't try to measure that. What we try to measure is how many interesting ideas and startups we bring into the organization. So how many are being trialed? How many are in a proof of concept? How many are being implemented? How much are we learning across the organization? Bill, great point. Like, is the organization learning? And that is the most important measure, right? Are we learning how to do a business differently? We also measure engagement opportunities with each of our business units. So we measure, the number of programs we do, the amount of discussion we have, how much we're helping them when they're doing an RFP for a specific part of their organization, how much we're helping them with market mapping and next generation technology, like kind of review. So we measure a lot of that type of thing. And that's around, again, learning for the organization, right? And it's around that innovation function. Then in general, there's a bit of, the way JetBlue kind of thinks of this is, we are thought leaders in our industry, or we try to be thought leaders in our industry. We spend a lot of time acting as thought leaders in our industry about what is the next generation of technology that can help this industry, and how can we change things, especially around like a lot of, the future of sustainability in this industry and all of those things. We have a heavy comms and marketing function. My manager of comms and marketing is amazing. And we have a lot of external press and conversation around JetBlue Ventures, and that reflects on JetBlue. And so JetBlue, really values that as well. So those are some of the measures.
Yeah. Well, and ultimately, in many ways, it's a shared responsibility where the business needs to be part of defining what's important and what matters. Well, I hate to say it, but we have run out of time. I would really like to thank both Amy and Bill for a rich and insightful discussion. And I look forward to continuing our conversation with you, with participants in our Landing the Value of Corporate Venturing course, which does kick off in October. And just give you a quick view of some upcoming GCV events that we have ongoing. We have the Institute, in addition to our Landing the Value of Corporate Venturing course, which kicks off in October, and Bill and Amy are both contributors to. We have several other upcoming programs, including 2 live online and 1 face-to-face conduct of our investment programs masterclass, as well as our parent partnering course in October. And at next week's Executive Leadership Forum in Palo Alto, we will be launching our annual CVC Operational and Performance Survey, which will be the foundational data set for our new GCV Touchstone benchmarking platform and service. We certainly encourage all of you to participate. The better the data, the richer the insights. And we do have forthcoming on the calendar for in-person community gatherings, GCB. We have regional events in Brazil and a delegation to Japan in November. And of course, we have the Monterey Summit in March and the symposium in London in June. And finally, number 2 in our next wave webinar series will be taking place on October 12th. The topic will be combating climate change, the role of InsurTech. So we encourage you all to join us then, and we thank you very much for joining us today. And anyone, questions, comments, or more information, please contact us at globalventuring.com or gcvinstitute.com. So thank you all for joining us. Thank you, Bill and Amy, for your insights. And I always learn something every time I talk to you. So thank you very much.